So now in chapter 6, we're really going to zero in and learn how to calculate that amount that we use when we debit cost of goods sold and credit inventory. So that's really what we're going to zero in on this chapter. So first of all, before we can get into all that, there's a few more accounting principles that we need to discuss. The first one is called the consistency principle. And the consistency principle basically says, look, there's a lot of area where GAAP gives you options. We're going to talk about that a lot more in Objective 2. We're going to see the options that GAAP gives us with regards to inventory. And GAAP lets us choose among a wide variety of options here, but it says once you pick one, once you pick a method, once you pick an option, you have to stick with it. You can't flip-flop this year to next year, and I'm going to use a different one the following year. So we have to be consistent. When we look at an annual report, you'll notice that the annual report gives you multiple years worth of data, usually at least 2 or 3. So we have to be able to look at, let's say, cost of goods sold and know that cost of goods sold was prepared using the same method every year. Even if we went back to 4 years and 5 years ago, that we're using the same method. So this allows some comparability over time. Another one is the disclosure principle, which says, again, if you're looking at that annual report, you'll notice that the financial statements take up about 4 or 5 pages, but then there's probably a good 50 to 100 pages of what are called notes, or sometimes called footnotes. And these are all places that the accountants go in and disclose. They give you some more information. So whatever information that, for example, we're going to talk about 3 different inventory methods, FIFO, LIFO, or weighted average. Whichever method they choose, they have to tell us in the notes. The rules say that if something would make a difference in a user's decision, it has to be disclosed. So if it would matter to you, if it would cause you to change your decision about whether you want to invest in this company, for example, then it has to be disclosed. And as always, as we talked about in Chapter 1, all of the accounting information that we provide should be relevant and faithfully representative, meaning it's neutral, it's free from bias, it is complete as far as we know it to be. We know there's a lot of estimates, but those estimates were made with all the facts that we had at the time and using our very best judgment, but removing our personal bias as much as possible. The materiality concept is an interesting one. So materiality says when we use the term material in accounting, what we really mean is significant, okay? So we know that there's a lot of estimates in accounting. We've looked at some already. We're going to look at a lot more as we go along. Estimates by their very nature are inherently wrong. We know that. But what we're saying is that we don't think these estimates are off by so much that they would be material or significant, meaning they would cause you to change your decision. Okay. So if I told you that Microsoft's income is off by $5,000, would you care? Would you say, oh, I was going to invest in Microsoft, but if their profit is possibly $5,000 less, then, well, now I'm not going to invest. Probably not, okay? Probably you're going to say $5,000, that's nothing to Microsoft, right? It's immaterial. It wouldn't matter. It wouldn't change your decision. Now, $5,000 in my personal finances, oh, that's very significant, right? So it just means, so what it says is that we know that some of these things are off a little bit, but they're not off by enough that it would make a difference in somebody's decision. And then the last one is conservatism. And we talked about this a little bit. I mentioned it back in chapter 5. But conservatism says we never want to be too overly optimistic, right? So we never want to overstate assets, overstate revenues, overstate gains. We never want to understate expenses, losses, or liabilities. So when we have 2 equally possible options, we want to choose the worst one because it's so much better if we come back and go, oh, hey, we recorded that liability, but turns out it wasn't really that much, right? Or it turns out we actually collected more revenue than we thought we were going to. Woohoo, okay? So we would rather present a worst case scenario and things turn out to be better than present a best case scenario and things not turn out to be quite so good.